So I'm very conscious about the power of monetary policy and the limits of it. And monetary policy, a la the aftermath of the Great Recession, can be very powerful to stoke demand. If you've got strong demand, there are limitations to monetary policy in increasing supply. So I think it's good to be cognizant of that. And my job is to do our work, talk to contacts, and call these developments out. But probably other parts of economic policy away from the Fed will have a greater bearing on these supply issues.
And therefore, when I come back to the jobs numbers, does that affect your view at all about discussion of tapering or even interest rates? You have been more willing than some to say at least we should start thinking about it or talking about it or thinking about talking about it. Did those numbers move you at all on that? Do you still think it's time to start talking about tapering?
And here's what I've said, just to repeat it with precision because it's gotten some attention. We have a substantial further progress benchmark. I voted for that in December. I've supported it consistently. We need to get to substantial further progress before we can start to taper. And we'll have a debate, of course, around the table about what constitutes that fine. What I have said that you're referring to is as we approach substantial further progress, I think it would be healthy to start a discussion in what I've said sooner rather than later. I'm not putting a calendar date on it, sooner rather than later, because I'm seeing excesses and imbalances and side effects of some of these purchases. I think that would be healthy to be able to discuss. And I'll give you one example, the housing market. How single-family homes are at historically elevated levels. That by itself would not as much faze me, although I'd be watching it. But what I'm hearing increasingly is reports of private investors buying homes sight unseen, squeezing out in some cases single-family buyers. And I think that trend has been increasing based on our work over the last couple of months. And that's an example of a side effect of our purchases. I think it would be healthy sooner rather than later, at least, to have some discussion about the efficacy of some of these purchases versus the side effects or even unintended consequences. And that's really the main thing I've been saying. And I guess I'll stop there.
Well, you're a student have been of the market so well. Give us a sense of what the markets are telling us right now, because a lot of people are saying if we look at things like Treasury break-evens, for example, real yields, various indicators like that, they're indicating that actually the Fed is likely to move up, either cut back on the buying of bonds and or raise the rates sooner than what the markets really have been talking about.
Yeah, and so I'll stay away from market expectations because they can change on a dime, and stick with focus on the economy. But I think I'm going to try to stick to this substantial further progress benchmark. But I think discussion's healthy. Again, sooner rather than later, because of these maybe side effects or even in some cases unintended consequences. And I think it's healthy. I hope at some point here in the not too distant future, we can begin discussing this.
As you know so well, the Fed has a new framework, I think you call it, for how you address the question of inflation. Yeah. Take that new framework and put it against what we're seeing in, for example, commodities prices right now, because we're seeing some record commodities prices. Does the new framework work with that record commodities level?
I think it does, and I support the new framework. And what it says is we're going to be less preemptive than we've been in the past in terms of anticipated inflation, and we're going to be more willing to let the job market run hotter to have more inclusive employment. Having said that, I've also said while you don't want to be preemptive, you also don't want to be so reactive that you're late, in that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance. I think it's the debate is about the implementation of the framework, where I'm sure there will be debate, and I think that's healthy, as opposed to the framework itself.
It's the implementation of the framework. There's also talk about the signals that are being given. There's a lot of talk about punch bowls these days and whether we're already drunk. And if we've taken away the punch bowl too soon, are we going to take it away too late as a practical matter? What do you say to those who say, wait a second, it is time to start withdrawing the punch bowl? We also had the financial stability report from the Fed last week that sort of warned a little bit about risk appetite.
Yeah, I would say I'm very cognizant of either excess risk taking in the financial markets, the situation with housing I just talked about, and other imbalances, and and this very heavily informs my thinking. And at the Dallas Fed and our team, we not only look at data, but we do extensive outreach, and we've dramatically increased it as the pandemic started, because sometimes the data can be late, it can be stale, and that outreach really informs us on how to interpret this data. And so I think people should have confidence that we're around the Federal Reserve System very vigilant and watching this very carefully. And while we may have debate and disagreement, I think our job is to be very much on top of economic developments, even if they're different than what we've seen before, and certainly I think very different than the aftermath of the Great Recession.
And finally, you want to stay away from politics, as you should. That's your job, to stay away from politics, and you never want to take a position on legislation. But how do you project out the future economic path of the United States when you have something like $4 trillion in additional spending that's pending up on Capitol Hill? Do you just wait until it actually happens, or do you anticipate at all the possibility?
Yeah, well, we're privately doing analysis. I usually wait to discuss publicly until some of the things have actually passed. But I would say the following, and I did comment on the concept of infrastructure. We need to grow faster in the United States. Over this horizon, we've still got an issue with an aging workforce, slowing workforce growth, and growth hasn't offset that. And so investments that improve productivity, I think, can help improve sustainable growth and ultimately will help us to deleverage or moderate our debt to GDP growth. But I would say I'm also mindful, and I've said this many times publicly, the path of U.S. government debt to GDP is unlikely to be sustainable. We're going to have to do a number of things, which I'll stay away from those because they're sensitive, to moderate this debt growth. But improving growth, workforce growth, and productivity is going to be a key part of it. You can moderate your debt growth and you can look at entitlements, but you got to find ways to grow faster.